ideally you want both, right? You want to be able to get a property that's bringing in money every month and you're making money. And then also as time goes by, the value of that property is also increasing. And one of the ways that you can kind of look at to see if a property is going to appreciate in value is population growth. Another way that you can invest in real estate, if you wanted a more passive way, is called a REIT, or real estate investment trust. So you can find these on the stock market. There are basically stocks that basically have a portfolio full of properties. And what they do is they use those properties to collect rents. What are you gonna do with that money, man? How are you gonna make the capital work? That's what it's really all about. Welcome to Capital Gains, a podcast where we talk about financial fitness and investing. My name is Sam Arekasima.
You don't need to be 18 to buy your first home.
No, I'm your host. On this podcast, we'll cover a variety of different investing. Over the years, how many businesses have you been involved with, either creating, funding, or just really getting involved?
People have the resources. They're just not resourceful.
Well, because I think when you're talking about even a millionaire, you're really talking about his mindset, right? And
How about if I'm lying? How about if I don't even have a dollar to my name?
you have an idea?
Woo!
And then the lender's gonna typically give you guidelines. They're like, we're only gonna give you this money if this property makes X amount of dollars. So when you're running your numbers and the bottom line is negative, the lender is not gonna give you a loan because Episode 8, we're going to be talking about real estate investing. My name is Sam Arekasima. I will be your host, and we will be talking about real estate and how you can use it to build wealth. You can also find me at Sam the Investor and catch us on Instagram, Capital Games Cast as well. All right, guys, let's get into it. So today I really just want to talk about real estate investing overall. I wanted to start from basically the lower level, and we'll go up to the higher level as far as property types and assets and things like that. So first, I wanted to cover just the typical real estate investing. You can invest in single family, 2 families, 3 families, 4 families, but let's start with the single family. So I see this conversation a lot, is a single family home an investment? And I've heard the answer yes, I've heard the answer no. I would like to say if the property is not producing income, then it is an asset, but I wouldn't consider it an investment, because if you have a mortgage and you have to make your monthly payment on it and you're not getting any supplemental income from that property, then it's really a liability, because no matter what, you have to pay that mortgage. It's coming out of your pocket and you really have to really just pay it by yourself. Whereas if you have, let's say, a 2-family property and you're living in one unit and renting out the other unit, you're receiving income and it's going to be helping you pay down that mortgage. That's where I would say it's an asset and an investment, because it's bringing in revenue. So I've seen some people buy a single family home and they'll actually rent out rooms. If you're doing that, now you're collecting income, and I would consider it an investment. So that discussion is kind of up and going, but it is still better to own a property, to me, and pay a mortgage than it is to rent, because over time that property will appreciate in value and you can, pay down the debt, and the appraised value will go up over time, and then it becomes really more valuable. So that's single family homes. And there are some people who only invest in single family homes. What I've seen right now recently is in the Midwest, single family homes are actually more, I'm not gonna say an easier, but a more desirable asset to invest in, because that's what's in demand out there. In areas like here in North Jersey, multifamilies, 2, 3, 4, 20 units, 100 units, they do very well because there's a high demand for those types of properties. In the Midwest, typically people have families and they need the space. So a single family home is actually more desirable and easier to rent than a multifamily unit in certain areas. So as you get into the more urban areas, it seems like the multifamilies do better. So that's kind of the thought process behind single family versus multifamily. Now let's talk now about 2, 3, 4 unit properties and how they can really help you build your wealth over time. Now, when you're dealing with, let's say, a 2-family or a 3-family or 4-family, you can apply for a typical residential type of mortgage. Those properties are going to be, you're going to use your income, your job, your W-2, your business income to go apply for a mortgage company. They're going to get you pre-approved. They're going to tell you you can afford a home for, say, $500,000. And then now you can put, a different down payment on. You can go as low as 3.5% with the FHA, 5% conventional, 10%, 20% conventional, really depending on how you want to do a structure or deal. Welcome to Capital Games. I am your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. Now, in my opinion, if you're getting your first property, it's best if you don't have a lot of cash, a lot of capital, to go FHA and take advantage of putting as little as 3.5% down. That way, now you don't have to wait as long to save up money to buy your first property. Now, if you do go that route, you're typically going to have to live in it. So in order to qualify for FHA, you do have to live in one of the units, and then you can rent out the others to help you bring in the income. Now, the good news about FHA is not only on top of only having to put 3.5% down, there are certain loans where, let's say you don't have the 3.5% down. There's loans where they can also help you borrow the down payment of 3.5%. Now, what that does is going to make your interest rate a little bit higher. Your payment's going to be higher. But if you're making good income, you can offset that and you can still get the property without actually having to have all that money for your down payment. And then also on top of that, in certain areas, you can negotiate with the seller to see if they're willing to give you a seller's concession, which you can then use to help lower your closing cost. So, for example, my brother bought a house last year, and we were able to use a New Jersey program where they'll help you with your down payment. And then we also got the seller to give us a credit for his closing costs, where basically he didn't pay anything to buy this property. Like, I think we paid like $1,000 out of his pocket. So these are the different ways you can structure deals, and you can do this on single family, multifamily. And that's why conventional or traditional mortgages work well if you're trying to get your first property. And typically, what I would also say is you want to get a multifamily first, because after you live in it for 1 year, you can now move out, rent out all the units. Ideally, the property at least pays for itself. Maybe you make a couple $100s a month, and now you can use that property to really build your wealth and build your income, and then now use that to help you get your second property. And ideally, if you are a real estate investor, you can use this as like a hack or a tool to really do this every year and really try to get one property in your portfolio every year over and over again. So it's really going to depend on what your strategy is and how you're trying to, go about building your real estate portfolio. So ideally, when you get your first property, you would like a 4-family property, because it's going to be able to more than likely, if not pay for itself very close, where you're going to live in one unit, rent out the other 3, and then it at least pays for itself. And then eventually, when you move out of that unit, you might be able to make a little bit of income, and then you use that income to help you pay for your next property. So that's the strategy that I like to use and try to implement, and tell my clients, hey, this is a good strategy and tool to really help build your real estate portfolio. And then on top of that, you can repeat that process over and over again. So that's one side of real estate investing, and one way that you can really build out your portfolio. Now, you can also go the route of, let's say, you want to get a 2, 3, or 4 family, and you want to go straight investment. Typically on these types of deals, you're gonna have to put down between 20 and 25%. So for example, if you were doing, let's say, a $500,000 property and you had to put down 20%, that means your down payment would be $100,000. Versus if you bought that same property and you would try to go FHA, your down payment may only be about $17,000. So it's a big difference as far as what down payment you need to bring. But let's say you've already got your FHA, you've already got your property tied up, your FHA tied up, so you can't use it, but you want to get another property and you have the 20% down payment. There's other loans that you can do where you don't have to use your income to qualify for the loan. There's a loan called the DSCR loan, a debt service coverage ratio loan. And these loans are great because they're not going to qualify just upon your income, just upon whatever business income that you can have. It's going to be qualified based upon the rents that the property receives. So let's say, for example, you wanted to get a 4-unit property, and you could rent each unit out for $1,000. That's $4,000 worth of income that the property is bringing in. Now, as long as your mortgage is less than, let's say, $400,000, a bank will actually be able to give you a loan based upon the $4,000 that you're receiving in rent to help you qualify for the property. So this is a great tool that a lot of investors use to build out their portfolio. Welcome to Capital Games. I'm your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. Now, obviously, you're still gonna have to put down 20%, 25%, but you're not gonna have to rely upon your personal income to help you qualify for the loan. So these are the type of deals that you can do and properties that you can get into. And if you want to be a real estate investor, depending on where you live, there may be great deals in the area you're from, but they may not be. Like, for example, in this North Jersey market, it's extremely competitive. There's low inventory. There are deals, but they're kind of few and far in between. But there's areas outside of New Jersey, like Midwest, the South, Texas, where you don't need as much capital because the properties are typically cheaper and you may be able to get a higher return on your down payment. So if you really want to get into real estate investing, you want to really expand your horizons, look at all the different markets that you could possibly invest in, pick one market that you like, you're going to do your research, and typically what most investors are looking for is either two things when they're buying a property. They either want cash flow, where every month they're going to receive a certain amount of money from buying that property, or they're going to want appreciation, where they know if they buy this property now, let's say for $500,000, they believe in 2, 3, 4, 5 years, that property is now going to be worth $600,000, $700,000, $800,000. And if you're buying in New Jersey right now, I believe most people are really buying for appreciation because of the high interest rates and the high cost. The cash flow is going to be very tight. So it depends on what type of investor you are. It depends on what you're looking for is really going to determine what market that you're looking at. And maybe you might have to get outside of the immediate area where you are and go outside your comfort zone and find a market where you can get either the cash flow that you're looking for or the appreciation that you're looking for. Ideally, you want both, right? You want to be able to get a property that's bringing in money every month and you're making money. And then also, as time goes by, the value of that property is also increasing. And one of the ways that you can kind of look at to see if a property is going to appreciate in value is population growth. If you're looking at a city or a market where you're seeing the population decline, it's probably not going to appreciate well, because in order for a property to appreciate, you're going to need to increase the demand or lower the supply. So if people are leaving a certain area, that means there's going to be more properties on the market, less demand, and the prices are actually going to decline over time. But if you're going into an area where you're seeing population growth increasing 1%, 2%, 3% every year, you know that there's more people coming into the area. And unless they're building more properties, the demand is going to keep on going up and the supply is going to keep on coming down, forcing prices to go up, which is exactly what we're seeing here in the North Jersey market. It's just very high demand, limited supply. They can't build the properties fast enough. And the newer construction properties are going for even higher prices because those are actually the properties that people really like. Everyone likes a new construction, new things. So if there's a new construction build, typically it's going to have a higher price tag because somebody has already done the work of renovating it and updating it. So you're going to have to pay a premium for that. So that's kind of like the first level, single families, 2 families, 3 families, 4 families. The next type of investing that investors can do when you're doing real estate investing is commercial. So on the multifamily side, anything 5 units and up could be considered a commercial property. I've seen some 4 units be considered commercial property because it could be like a laundromat on the first floor and then 3 units, 3 residential units on top, and that could be also considered commercial. But generally, anything 5 units and up, as far as multifamily, would be considered commercial. Those loans are going to be structured differently than your typical conventional mortgage because, again, with these loans, you're going to want the debt service coverage ratio where the amount of income the property is bringing in is really determining the value of that property as well. So let's say you have a 10-unit building. Each unit is bringing in $1,000 a month. That would be $10,000 a month, $120,000 a year. And then typically 1% of the rental income, you would want for the purchase price. So you'd pay. Welcome to Capital Games. I'm your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. Typically 1.2 million, maybe 1.5, to actually get that deal, covered by a bank where they're willing to lend you the money for that property. So if it's a $1.2 million property, the bank's going to tell you, hey, put down, 20%, 25%, and then we will give you the loan for the difference. And that's how you can actually buy a 10-unit property. And the beauty of those types of deals is if you find a property where, let's say it's $1,000 a month in rent, but let's say that property needs work, right? And they haven't done any renovations, and you buy that property at, let's say, 1.2 million, and then because you're gonna reinvest money into the property, you're gonna fix up the bathrooms, fix up the kitchens, and then now let's say you can get $1,200 a month for rent. That increases the monthly income, and that's also gonna increase the value of the property. Those are called value add properties, and these are ways that investors use to be able to buy a property, renovate it, add that value, get a higher valuation, a higher appraisal, and then after they've done the renovations, after they've increased the rents, they can then now go back to the bank and say, hey, I bought this property for 1.2 million. I've done renovations and I've increased the rents. Now this property is worth 1.6 million, 1.8 million. And then they could actually refinance, and the bank will typically give them, let's say, between 80% or 75% of the loan, of the value of the property as a loan. And then they could actually pull cash out of that deal and repeat the process, and then use the money that they bought out of the deal to actually invest in another deal. So that's called the BRRRR method. You can do this on a 2 to 4 family level, but you can also do it on a larger scale as well. So these are different tools that investors use when they're trying to buy properties, when they're trying to increase their portfolio, trying to negotiate. All these different ways are just ways that you could really get into real estate investing and use different tools to really structure deals and understand how you can use real estate to build wealth. And typically with real estate, it takes time for these properties and to really be as valuable as you would want them to be. And you really have to give it time, because sometimes it may take 5 years, 10 years for the appreciation to really go up, and then you can refinance again, pull cash out, and then get the value out of it. So it's typically going to take time, but you can force appreciation by doing the renovations as well. So next I want to talk about a different type of property or asset class, which would be short-term and long-term rentals, right? So these are your Airbnbs. These are your midterm rentals, where it's typically 6 months to 3 to 6 months, where you might rent it out to, let's say, a travel nurse, where they just need it for a little bit of time. Your Airbnbs, these things that you're typically seeing now, your vacation rentals. So this is another type of investment, real estate investment that you can do. So let's say you have a property, let's say in Miami, Florida, right? You buy it, let's say it's a condo, and your plan is to Airbnb it. You're gonna basically, at this point, when you're doing Airbnb, it becomes a business, right? But because you're not renting it out, let's say on a month-to-month basis to a tenant, but you're doing short stays, 1 day, 2 days, 1 week, whatever that somebody's willing to book it for, you can typically get more in rents than you would if you just rent it out to one person for like a whole year. So, but since you're doing that, now you have to worry about the cleaning, the marketing, just the upkeep of the property, and all the things that go along with Airbnb. But these are ways that investors have found ways to really get more value out of a property and get more income out of a property versus the traditional rental way. So, Airbnb, vacation rentals, short-term rentals is just another vehicle to use to create wealth and invest in real estate. So if you like businesses and you like running businesses, then Airbnb, if you're willing to do the work, you can get a higher return on your money on your down payment typically than if you did like a regular 1 year lease and things like that. So welcome to Capital Games. I am your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. That's just one more avenue that you can really use to get into real estate investing and build out your portfolio like that. So another way that you can invest in real estate, if you wanted a more passive way, is called a REIT, or real estate investment trust. So you can find these on the stock market. There are basically stocks that basically have a portfolio full of properties. And what they do is they use those properties to collect rents. And then the rents that they collect, they get given back to the investors of the stock. Right, so it can be given through dividends, where let's say you get a 8%, 7% dividend for holding this stock. So it's more passive, where you're not necessarily owning the property yourself. You're buying the stock, and then you're getting the rental income in the form of dividends. So if you want a more passive way, you don't want to be a landlord, you don't want to have to deal with a property manager, but you still want to have some real estate in your portfolio, that's another way that people choose to invest in real estate and have a little bit more passive, hands-off way of investing in deals. And so that's one more avenue where you can really try to tap into become a real estate investor. So another way is a typical fix and flip. So fix and flips are good if you are very hands-on, if you understand a certain market, if you want to get your hands dirty, if you want to worry about having a crew and looking for value add situations. So basically a fix and flip is where you'll find a property that's typically distressed, needs work, needs rehab. Let's say a single family home where, it was a hoarder house and it's a complete mess. A retail buyer is not going to want that property, right? Somebody who's trying to buy their first property is just not going to want that property to take on for their first property because all of the work involved. They may have a job where, they don't have the time or energy to put into buying a property like that. That's where a fix and flip investor comes in. They says, you know what? I'll take the headaches. I'll take all the work that goes along with that property. Let's say it's a single family. They buy it for $200,000 and their plan is to put $100,000 worth of work into it and then go ahead and sell it to a end buyer for, let's say, $400,000 or $450,000, right? That's a fix and flip where they're buying it and they're going to fix it and they're going to flip it to an end buyer who's going to pay a higher retail price because all of the work of the renovations and permits and, dealing with the crew and supplies, that's done by the fix and flipper. And then they're just willing to say, all right, well, you've done all that work. I just want to buy the finished product. And that's why fix and flip investors, do deals like that. And it really depends on your goals. Like fix and flips are great ways to just build cash and build capital. Me personally, I'm more of a buy and hold person myself, whereas I don't necessarily I'll do a fix and flip, but I really want to own the asset and just collect the rental income. It's not going to be as big as a payday of a fix and flip, but I'm going to own that asset over a long period of time. And I'm going to collect the rents and I'm going to get the tax advantages and, the appreciation and the tenants paying down the debt on the property. So that's kind of, my strategy, but fix and flip is a great way to just get income. And typically if you can get in and out of a flip between 3 months or 2 months, 3 months, 6 months, the shorter the time that you can be in that property, typically the more profitable it's going to be. But at the same time, if you're doing a larger renovation, you need to get permits and things like that. It's gonna take even longer, but you may be able to get a higher return on the money because you're gonna have a better product at the end. And so that's one more way to do real estate investing. And I guess the next step from there would be just ground up development, right? If you're building a property from the ground up, you see a piece of land, you're gonna develop it, you're gonna get all the permits, the zoning, everything that goes along, you're going to develop that property from ground up. That's another way to get into real estate investing. And, some people will build a ground up property and they'll sell it. Some people will build a ground up property and they'll rent it out. So to me, ground up development is probably the best way. Welcome to Capital Games. I'm your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. To build wealth, but it's also the most intensive, the most risk involved because you're starting from scratch, and the time frame on those can take a lot of time. You know, some people get very good at it and they can build properties quickly and efficiently, and they can find a buyer or they can find a renter quickly after. But sometimes, you know, depending on when you start a project, you know, you may think it may take you a year. The next thing you know, you're 2 years and it's still not done. And guess what? That whole time you have money that you're paying every month. You're paying the taxes, you're paying the utilities. If you have a loan, you're paying the mortgage. So it's more risky and it's a higher intensive with capital, but the end result is it can be very rewarding because since you're taking on more risk, you're going to get more of a reward. So development is definitely something that I haven't done a ground up construction yet, but those are the projects I know in the future that I'm going to be wanting to try to tackle and take on as I, you know, have more capital, I have more time, and to invest in some of these longer term projects. That's definitely the way I know I want to use my time. So that's one more way to get into real estate investing. And then one of the last ways that I want to touch upon is something called syndication. So there's things that you can do. Let's say you have a 100 unit or 200 unit building, right? And let's say that property costs $40 million. If you have the capital and you have the cash, you can go out and let's say if you have $40 million laying around, you want to buy a property like that, you can just go out, make the offer and buy that property. But a lot of people, what they'll do is they will actually pool money together, right? They'll go find investors, right? Where let's say it's $40 million and the down payment that you need for that property is going to be $10 million, right? 25%. You're going to go raise the 10% capital that you're going to need for the down payment. That could be through investors, that could be through different avenues, but you don't need all 10 million yourself, right? And this is where the syndication comes in. So you may pool a bunch of people investors. You can have like 100 people all pulling their money together for this down payment for this property. And then you're going to get a loan out for the other 30 million. And then the plan is, let's say you bought a property where, you know, it's 200 units and each unit is rented for 1,000, but you also believe that you can renovate those units and add value. And then now you're going to be able to charge $1,200 or $1,300. And then over a 5-year period, you're going to transform that property from receiving, let's say, $1,000 per unit to $1,200 per unit. And then all the investors that you're pooling their money together, you're going to say, hey, give me 5 years. And in 5 years, not only will I pay you interest on the money that you're receiving, but when we sell this property, you're going to get a percentage based upon how much you put in on the upside of that property as well. And that's why syndication deals work because it's somebody who like wants to invest, but not necessarily do all the work of finding the property, doing the renovations, managing it on a day-to-day, increasing the rents, but they still want to be involved. So they just might write a check for $100,000 or $200,000 or $500,000 to be a part of that deal, but passively, right? They're not doing the day-to-day. They're not, worrying about contractors and property managers and paying the taxes, but they are involved and they're putting their stake in it. And those are syndication deals. And, I've seen syndication deals with as little as $20,000 where you can be involved in, or a minimum of $50,000. It really depends on what the deal is and what return that syndication partner is willing to give you. Typically, as the syndicator, if you're the person who's going out and finding these deals, you can have a stake in it just from finding the deal, negotiating the deal, and pulling all the funds together and basically being the point person. You might end up with 1 or 2% of the whole project. So that way, when it's sold years later, now you can exit that and you can get your investment. Or you can choose to say, all right, maybe you put the whole deal together, and then in 5 years, when it's time to sell, you say, all right, instead of selling it to some hedge fund or some private equity firm, I want to buy it back myself, right? And you might come back with a pool of investors and say, hey, you know what? We'll buy this asset now that it's stabilized and the rents are good and we've increased the value. And then now you become a long-term holder of that asset, and that's really a great way to get involved in larger deals and really, learn and do different things as well. So syndication is welcome to Capital Games. I'm your host, Sam Arekasima. In this podcast, we will cover financial education, financial entertainment. We'll cover a variety of topics. This will be a community where people can give feedback, learn information, and if this is the type of content you like, subscribe, share, and tune in, and we'll catch you next time. A powerful tool as far as building a real estate portfolio, and it's going to really help you get into larger deals. I believe this book here, 10X by Grant Cardone, he does a ton of syndications. That's actually his business model. He likes A-class properties. He likes, what's it called? Like not office buildings, but like complexes where it's retail stores. It might have some residential, bigger deals like that, maybe $100 million. And then, he pulls investors' money and then he'll give them a check. I think he does it like every month where he's paying out the investors who are putting money into these deals. So syndication is definitely a great way to really, just build a larger portfolio much faster than you typically would. And these are the kind of things that you can do as a real estate investor to really grow your portfolio. With that being said, I'm an investor. I'm always looking for deals. I'm trying to find properties. I'm looking to buy properties and things like that. But as far as on the real estate side, I have my real estate license. So if you're ever in the North Jersey area and you're looking to become a real estate investor, reach out to me at Sam the Realtor on Instagram, Sam the Realtor on TikTok, and I will actually help you get your either first property or second property and really guide you through the whole process of looking at a deal, doing the underwriting, which is just the numbers and seeing how much a property is going to make and see if it makes sense for you and see if we can if you have a dream of becoming a home buyer and becoming a landlord and being a real estate investor, those are the people that I'm targeting to help. And, I really want to educate people. And this is why I have this platform to really kind of amplify that. So if you know anybody who's looking to become a real estate investor, if you yourself are looking to become a real estate investor, follow me on Instagram at Sam the Realtor to see more of the investing stuff at Sam the Investor. And, we can really kind of collaborate, and I'll be willing to help, anyone who's looking to become, an investor or just has questions. I'm really looking to build out a community. This podcast, Capital Games, is on YouTube. There's clips on Instagram as well, Capital Games Cast, where I'll talk about, real estate investing. I'll also talk about some other investing things, but since real estate is my primary business, you're going to hear a lot more content about real estate. And if there's any way that I can be of service, let me know. I have a network of mortgage lenders, inspectors, credit repair people, contractors, and I'm opening up my network to anyone who needs it and who wants to be helped. That's really the mindset that I have, is willing to help as many people and impact as many people as possible. So if you are that person, reach out, stay tuned. I'll be sharing more information like this. Thanks for watching, and we will catch you next time.